Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Hey, Zach, have
Hey,
you heard that intro before?
I,
That's
I
how
don't. I
we
don't know if I
intro the
have.
videos. Hey, Zach, what has two thumbs and is a C-rate podcast host?
What's that?
This guy.
Hey.
Hey.
I I have no idea how this show is gonna go. Never hosted before. Danny's on vacation. Uh, and let's just see where it heads. Zach, I'm
Yeah.
going to ask you for some man on the street opinion
Oh, sure.
on several things. Let me ask you a question.
Yeah.
When you think of investing, what is your initial reaction? You produce, hear us talk about what we espouse here at Revere: upside participation in the market, downside protection. We don't want people to get their butts kicked. You've heard the horror stories that we've told about people who lost their money for incompetent money managers. And what's your reaction to investing? How does it make you feel?
Well, first off, I think whenever I think of investing, I think of Revere, of course, because they're the best in the business. Nobody else to go to. But
Well, that
two,
that brings a tear to my
it
eye.
should.
Let me wipe that tears
I hope
away.
it does. But two, I think caution. I don't know. I think I'm a small fish in a big pond when we talk about investing. I think I don't know a lot. I think I need to talk to people that do. I think I need to, get an opinion because, like, I don't know. I feel like I wouldn't feel empowered in my decisions because I don't know enough about it. That's what I think.
Here's the way I look at it, and I say this a lot. We think that people's approach to the market should have a common sense aspect to it, as Alex chokes on a hairball. Is that from your
I thought I
dog?
muted my. I thought I muted myself there. I didn't mute
I
myself.
should, yeah,
My
So
apologies.
we
should have been
think
quicker on the draw.
we think investing should have a common sense approach. What aspect in your life, when things start going bad, do you not take corrective action? If the service engine soon light comes on in your car, what do you do?
You go get a fix.
If you're heading out for the day and you see that the forecast is for rain, what do you do?
Bring an umbrella.
If you've got a leaky pipe in your house that's flooding your kitchen, what do you do?
Call a plumber.
If you've got a portfolio that's bleeding red and heading lower, what do you do?
I like these questions. These are easy questions. I call Revere.
You call Revere.
That's
Why do you
right.
call Revere? Because the typical investment advisor is you're going to get on the phone with them, you're going to express your concerns. Hey, I'm down 20%, and they're going to tell you to think long term. And they're going to tell you to hang in there. And they're going to tell you, we think we might be near the bottom, but if you miss the best 10 days of the market, your returns are completely going to be down to zero. But they won't tell you that if you miss the 10 worst days in the market, that your returns are going to be off the chart. And they won't tell you that if you sell their mutual funds, that they don't get paid. And they won't tell you, because they're salesmen.
Yeah.
They don't have the answer. This is why 90% of typical investment advisors suffered from post-traumatic stress disorder symptoms, PTSD, after the 2007 to 2009 financial crisis. Because can you imagine being on the other end of phone calls from your clients that are distraught and you've had no answer for them, and you told them to hang in there down 20%, you told them to hang in there down 25%, you told them down 30%, you told them down 35%, you told them down 40%. You see where I'm going with this? And we
Nightmare for you.
bottomed at 57% below the highs on the S&P 500 is where we bottomed after the financial crisis. Imagine if you were going into retirement, and a lot of these salesmen run what's called a Monte Carlo simulation, and what they're trying to do is assess prior returns and project them out to the future. How many Monte Carlo returns at the beginning of 2000 forecasted 250% drops over the next 9 years? I'm going to bet zero, because it's not a historical norm. It was completely out of, it was completely non-compliant with anything that we've seen in the history of the markets before. And to tell people to not take corrective action when they're concerned is, to me, malpractice. But it's unconscious malpractice because they're employed by the industry that has pushed this false narrative that you have to stay in the markets all the time. Zach, bring up the chart. Let's show the people the chart, and I'm going to show them something just ridiculously simple. This big black line here is the difference between a long-term healthy market and a long-term unhealthy market. And when the price action gets below this big black line, this is where historically we're at risk of extreme or severe losses. Now, historically, we've tracked 12 bull markets since 1970. Some of them are just a garden variety where you're down 20%. It's not that big a deal to come back from them. But there have been 2 over 50% drawdowns. There's been a 34% 5-week COVID drawdown, where imagine if COVID had a 4% death rate instead of a fraction of 1% death rate. There's no telling where the markets would be right now. So for the buy and hold people, they say, see, it came back. Well, what if it wouldn't have come back? Obviously, we'd have had bigger things to be concerned about, but if your capital's protected, you don't have to worry about it. And now just recently we had a 24% pullback off the top as part of this 2022 repricing of risk. Ukraine-Russia war, rising interest rates, Fed tapering and balance sheet reduction, out of control inflation, and strong US dollar. But this black line here, if you just get out of the way when you're below the black line, stay invested when you're above the black line. I've shown the stats before. You will never get seriously hurt in the market because the average loss from the top to this black line when you have a close below it on a weekly basis is 12%. 12% is extremely easy to come back from. 20, 25, 30, 40, 50% is not easy to come back from. And it's the unconscious incompetence of salesmen or pie chart pinhead advisors, as I like to call them, that will get you murdered in the market. And now they're saying, oh, look, we've come back off the lows 11%. Okay, we're still below this declining 200-day moving average. We still have inflation. That's a significant problem, along with those other problems that I just listed. And we haven't solved them. We don't have a solution right now. If we just had, today is Friday, August 5th at 10:50 a.m. pre-market, we had a very strong jobs report, and that had the market initially sell off. It bounced back. We're declining, but these little silly lines on a chart that we look at here and we follow, there's 3 time frames. The black one I already talked about. The green one is our short-term average. When we're above there, we want to be partially invested. The red one is our intermediate term average. When we're above there, we want to be a little bit more invested. And that's where we are right now. When we're down here under all of them, we're out of the markets. We're very nearly all out of the markets. When we pop our head above it, we start buying some things. If we break below it, we sell them. Pop our head above, we start buying, we sell them. Again here, and now it sticks, right? We're up 11%. So what are we going to do? We're going to invest more, and as long as we keep making money, we'll keep putting money back into the market. We get back above the 200-day moving average, the downtrend is over on a long-term basis. And now we're back in the market. We saved all of this headache, all of this worrying if you're 2 years from retirement about what your nest egg is going to look like when you do retire. And we dodged it, and we're back in and we're participating. So another myth sold by Wall Street is that you not only have to time getting out, but you have to time getting back in too. We got it solved by 3 simple lines on a chart, and then paying attention to the leading stocks and the leading sectors when the market is going up. Sounds easy, sounds simple. It's not. There's a lot of work that goes into it. There's a lot of work that developing the system that we've put together here at Revere. We've got a great support system in place. We've had some people leave, and we miss them dearly. That's part of the business cycle. And we've got new people coming in that are extremely qualified to lead us to where we want to go for our clients, which is higher in their account balances and stay away from catastrophic losses. And that's Revere in a nutshell. Now, how do you feel, Zach?
I feel great. I feel like $1 million.
You want to run through a brick
confident.
wall, don't
I
you?
sure do. Yeah,
right.
You betcha. My gosh.
All right. I did an interview with Richard Moglen 6 weeks ago in the middle of June. It was right near the bottom of the market, and it allowed us to reach an audience that we hadn't reached before. Our social media presence has gone up. I've got 30% more Twitter followers than I did. Our viewing on our nightly videos has doubled. Our YouTube content is watched way more. I've had 27 people apply for the job that Michael got, and they keep saying, "What can I do to work for Revere?" Because I think what we're doing is exciting. I think we're solving a problem for a lot of people, especially people that are within 5 years away from retirement, and you've saved and you're uncomfortable that you might lose that because of what's going on with the huge deficit that the government has racked up with rising interest rates, rising inflation, which we have to solve inflation or we're going to have a problem. And we think we've got the solution, and we want people to tell their friends and family, and we want them to embrace the sleep at night factor that we apply, that we provide for our clients, and that they tell us all the time. Man, I've seen so many people upset this year with what they've lost, and going back to 2007, 2009, and 2000 to 2002 when the tech bubble blew up, and people had typical advisors had no answer for their clients, and we've talked over and over again about family that we've seen suffered during these periods, friends and family, and heard from clients that just lost a lot of money all because they didn't have a sell strategy. And we think we can provide that, and we'd love to talk to you about it if you're new to listening to Revere. We talk trading too. There are a lot of traders that follow us because ultimately what we're doing is following a system of risk management, entering positions in stocks when the market is in our favor, and having a sell strategy, either lock in profits or cut losses short. And it's being embraced. A wider net has been cast with my interview with Richard, and we couldn't be happier with the way 2022 has played out, except for the great people that we worked with that have moved on. We'd love to have them here, but we don't, and we'll deal with it, and we'll bring on the next generation of people that continue to work with us. Show Alex, for instance. Alex was a full-time Revere employee. There were some aspects of the job that just weren't right for him, and we respected that. Alex is a very successful trader. He knows how to read the markets, and that was the best quality that he brought to Revere. There were some other aspects of the job that he wasn't particularly fond of. We parted as friends, and we keep him on as a consultant because he provides a valuable insight to us on the markets. It double checks us. If I'm thinking something, he's going to tell me, well, that might be right, but you also might want to think about it this way. And the bottom line is Alex is an expert at what he does. And that's why he's sitting on this podcast that we're doing today, because he provides an extremely valuable service to us. Now you got Michael. Like I said, 27 people wanted the job that he wanted. Head and shoulders above the crowd was Michael. I talked to some people that worked with him. They raved about his work ethic and how passionate he was about the markets. He came on board and passed the Series 65 test within a week to get licensed. That's unheard of. It's a difficult test. He's a good test taker. He crammed for a week and passed. And hats are completely off to him. The first 2 weeks of our relationship with Michael have just been fantastic. There's going to be other people we're bringing on board down the road in the future. There's going to be other consultants that we're working with to solve the needs of our clients. And I am just ridiculously excited about what we're building into the future at Revere here. So that out of the way, what we're going to do in today's podcast is, now that I've done my monologue, we're going to talk a little bit about the markets. Alex and Michael are going to provide some input. I'm going to talk a little bit, and then the last part of it is going to be a review of this 13 rules that I put together years ago. Guideline. It was shortly after I started with Revere, and this is something I put together for marketing purposes. Initially, I was thinking about starting my own register investment advisor before I saw Revere on Twitter, and the more I dug into it, the compliance and the fact that you have to spend so much time trying to bring people on board would have taken so much time away from what I want to do, which is really manage portfolios, that I'm really happy with the way things turned out. But this was developed, and we're going to go through it, and it's going to be kind of like an evergreen greatest hits show that we can show if it's the holidays and we're unable to have a podcast or anything. So, Alex, you want to kick off what you're seeing in the markets right now, and give us a little bit of color on what you're looking at.
Yeah, as Don had spoken about, the jobs numbers came out today, unemployment numbers lowest in I think 40 years. So the market backed off a little bit. We have rallied for about 3 weeks straight. So I think it was time for digestion, regardless of the news. Price action will dictate what we do. So I actually find this as a good opportunity to, let's see if leading stocks can base and set up new buy points. For example, like a leader like look up ENPH, which I think Revere does have a position on, has been slowly accumulating every day since its big gap up on its earnings on massive volume. That's the sign of a true market leader. So with this pullback in the market, you can see EMPH is like flat on the day. That's a sign there's no real selling going on. And I take this down day as bull market action. It got absorbed. Half of it, 50% of it has been retraced, meaning, let's say the market's down 100 points. It's trading only down 50 now, so it's absorbed half of that loss, which to me is bulls coming in and buying the dip, and it's healthy action. We got to allow these shorter term averages, like Don was talking about, the 21 EMA, exponential moving average, to catch up and allow the market to digest this prior big move, and stocks like EMPH to allow their averages to catch up. So if we get some sideways action on those charts, or even like a little bit of a handle, a little downward action's okay, that could set up a next leg higher. The next leg higher will be the previous S&P 500 highs back in early June where we rolled over. If we break above that, that'd be a new short-term high. To me, the rally could continue. I don't like putting labels on things. Everyone's like bear market rally or new bull market. It doesn't matter. The only thing that matters is if you're making money. So I don't think about 10 years down the road, 2 years down the road with my investments, because who holds the stocks that long? Like Don said, there's going to be bears within that. You'll lose you're going to lose your investment. You know, it doesn't work like that. So I think about what's happening today and now, and I take it day by day. If the stock I own or the investments I own turn into long-term year, 2-year holds, so be it. That's great. But I don't think about it. I don't like labeling it. So I'm looking at what's setting up right now, and right now I'm seeing a healthy digestion in the market. So that's where I stand. Some of the leading names, like EMPH, I'm following. Some of the chips look like they're setting up, like On Semiconductor, KLAC, NVIDIA, AMD, gap down on earnings, and then within 24 hours, shot above its earnings gap open, and was trading higher yesterday on a lot of volume. That's pretty good action when the stock gap's down. That wasn't the only one. On did the same thing on its earnings. It came down, and then it fired back up within the next few trading days. A couple smaller illiquid stocks, something that Revere has to be careful with because of liquidity. You know, there's liquidity requirements. Don usually likes to find stocks that trade $100 million of average trading volume a day. I'm watching Dutch Brothers. It has been liquid in the past, but lately it's been a little bit dry. But this thing is fired back up. And Don had pointed something out. I don't know if you could pull up a chart and Don could show bros, but it had gapped down a few months ago down to $20. And that seems to have put in the bottom. So I waited a few months because I've been a big bull on this name. I know this company. I've been following them since college. I love their drinks and I like what they're doing. I like the story. Um, on the right side of here, I think it was like a week and a half ago, there was a big up day through the 21-day moving average. Yes, that bar. I bought it there. I like it's just like a bottoming base on the right side. It's a little bit of a different method, but the RS line, the 3-month RS line, was pointing up. Um, so I bought it, and this has been one of my better names that I own. Yeah, the 3-month is at 82. So that, or excuse me, 92. So that to me was another sign that it's got the relative strength. The up down volume might be 1.5, 1.8. That was another good indicator. Um, you can see the composite rating there is not that good. That's probably because of the price action in the previous sales reports. But moving forward on the earnings call in 5 days, I will definitely be listening in to see what's going on. You can see that 2023 estimates at 133%. They don't really have any competition. Starbucks, in my opinion, is a thing of the past. And I actually compare this to Starbucks of early 90s, late 80s. William Danoff's a top fund manager at Fidelity. He's one of the best fund managers of all time. He's actually a big Cancelim guy and followed O'Neill for many years. One of his first trades was Starbucks, and he followed it to the T and invested in this many years ago. And that was one of his biggest winners. So I do think that Dutch Bros has the potential to do something like Starbucks did back in the 90s. Here's the big thing: we need the market to cooperate, because if the market rolls over, it doesn't matter how good the story is; it will sell off. So those are kind of the names I'm watching: those EMPHs and semis and new growth stocks like Dutch Brothers. Those are kind of what I'm trading and watching at the moment.
Thanks, Alex. So what I'm
Yep.
showing here is a 15-minute chart of the S&P 500, and what we were looking for on Wednesday was this. We had this prior run up after the Fed, and then this 2.5 to 3 day bull flag, where a bull flag happens after you make a run up, and then you just start kind of gently going sideways to down, but without any significant volume that would indicate a lot of selling. So this little bull flag was put in Wednesday. We were looking for some strength. We got a little gap up, and then we got follow through to the upside to break above this 4140, 4145 level. And then, so that was the bull flag breakout. Then we want to see that hold. And what we saw on Thursday was a little bit of selling in the morning. We undercut that pivot, but we got back above it. We got down to 41.35, which undercuts 41.45 and 41.40. But then we closed above it. So now this morning, we had the gap down. We got as low as 41.08. On the morning gap, and it was bought up immediately. And now we're pulling back again and retesting it. So what we want to do is see again what happens. Is this a false breakdown below this 41.35 level? Or is this a false bounce? It could go either way. We don't predict. We watch what's happening. We watch what's happening with our individual positions that we have, and we react accordingly. So the best case scenario is this pullback today, this morning, it's 11 o'clock Eastern time, is contained by this 4130 to 4140 area, and we end up higher, maybe around 4150, or make new highs on here. So the bull flag breakouts very often get tested to see if they can hold. So far, it's holding with this gap down. If we break below the morning lows today, that's a very bad sign. That should not happen. We don't want that to happen. We'll start putting some hedging or trimming some positions on if that does happen. So far, it's not. And again, we don't predict. We're interpreting the price and volume action of what's going on the indices and on individual stocks. NASDAQ 100 a little bit stronger. You can see it hasn't even come down to test the top of its bull flag. which is actually it did come down, tested it, and bounced right there. That's the 318.70 level. The highs of these 2 days, and this little gentle pullback before we broke out, went sideways yesterday, gap down today, and we're pulling back again, but we want to hold this 318.70 area. Worst case 315, and the breakout is failed in my opinion, and then we'll again take corrective action, take a look at what our positions are doing, take a look at what the indices are doing, and take our cues from the market, not predict. Michael.
Don, I got a question real quick before
Yes.
Michael goes. I had a family member call and asked, "What do I do now that the market's starting to rally? Do I buy it here, or what would you say?" I hate to put you on the spot, but how would you respond to something like that if someone called you? They weren't with Revere, and they said, "What should I do with my investment? Like, I have a bunch of cash in an account, and I don't know what to do."
Well, first thing I do is I tell them to start watching our nightly videos, and then they'll know exactly where we stand on short term, intermediate term, and long term on the trend. I don't know what kind of an investor they are, but you don't plunge, you don't go all in all the time.
Yeah.
Buy something and set a stop. It's really that simple. We should hold above worst case this 314 area, which is where we broke above on the Nasdaq 100. We haven't cleared that area yet on the S&P 500. Tell them to buy what kind of investor are they? Do they buy individual stocks? Do they?
It's if it's someone that has, like, let's say they have a 401k with a company and they can only make a certain amount of trades within a quarter. I think I don't know the exact rules, but it's usually like S&P funds or Vanguard funds. They don't really do individual stocks, but they can sell and buy based on the market. They had
Right.
sold, but now they don't know what to do. Like, do they buy back in? And I didn't know what to say really, because I was like, because I typically trade individual stocks. I don't do my trading based on it, so I figured I'd ask you and see. And I think this would be a
Yeah.
good
So what
question for some of our viewers.
It would. There's probably a lot of people that think this or have family members that do. When you have a 401k and you're limited to the number of trades that you can make, you eliminate the short-term moving average and then just look at the intermediate term and the long term. Once we get a weekly close back above the 50-day moving average, I would say put some of your money in. And if we get back above the 200-day moving average, you can put the rest of it in. And if that fails, sell it out. I
Thank
don't
you.
take the and their age has somewhat of a factor into it. If they're
Right.
younger, you don't have to worry about it as much. But even when I was younger, I didn't want to lose 50% of what I had saved to that point in my life. So, but the 200-day moving average is really the key when you're talking about 401ks, because that's when risk significantly picks up when you're under the declining 200-day moving average. So the fact that we got back above the 50-day moving average 2 weeks ago, I would say they could put some of it back in. And if we break back below the 50-day moving average over the next couple of weeks, it's a paper cut to them,
Yeah.
and you can get
Gotcha.
back out. But you can't stick your head in the sand. You've got to have some sort of guideline
Hmm.
to what's going on. Um, that would be my recommendation to somebody that's got a 401k and is limited to the number of changes that they can make on a quarterly basis. You
Because I find it
have
interesting
to,
that it's more of the questions is when to buy, not when to sell. They're always asking,
right.
should I buy more? I'm like, well, I don't know where you sold it. Like, it's very complicated. Like
Yeah.
you said, the
I would,
age matters.
yeah, the intermediate term and the long term, I would eliminate the short term fluctuations if you're in a 401k.
Okay. Thank you.
Yeah, and what I would say about that is a lot of the accounts we manage are 401ks, and because it's so complicated, it's very difficult to do well in the market. Most people don't, and timing is something that unless you're professional, you're or unless you have a lot of experience, it's going to be very difficult to get right. So I would say the best thing you can do is to have your money with a professional manager, and not just any a manager like Revere. So. I think Don and Dan, um, you should get in contact with them and see how you can set up an account with Revere, because that's probably your best bet.
This in the video we show this trend gauge every night. I'm going to bring it onto the screen, and we cover four things. We cover leading stocks, our short-term trend, our medium-term trend, and our long-term trend. You can see the long-term trend is still down because we're below the 200-day moving average. The medium-term trend, the 50-day moving average, we went early in July, we went from down to neutral. End of July, we went to neutral to up. So just using these two indicators here on a nightly basis on our video, and honestly, you don't even have to watch the video. If you bring up the thumbnail, this is always displayed on the video for that night. You wouldn't even have to listen to the video, but we want you to listen to the video, and we want you to share it with your friends and family. So
Gotcha.
that's our shameless plug.
Mhm.
So Michael, what are you focusing on in the markets?
So I just wanted to revisit something you mentioned earlier that I think is really important and not something that that people consider, and it's you have to kind of see the numbers and think about it for it to make sense. But when you were talking about taking a loss or the market coming down, um, when markets are coming down and you have losses, the way that they move is a lot greater. It's exponential compared to the gains you need to recover from that loss. So for example, when you if you're down 10%, as Don said, 10-15%, you can recover from that because a 10% loss requires an 11% gain to get back to break even. So it's almost the same. 20% loss requires a 25% gain. But then when you get higher than that, a 40% loss, for example, requires a 67% gain, and a 50% loss requires you to double your account. And it's a lot more difficult to double your account than it is to make up a 10% loss. So that's why it's so important to sidestep those major declines. And if you're able to get out of the way, then once you get back into the market, it's a lot easier to recover from those losses than if you just ride it all the way down. So I think that's something really important for people to realize and consider because losses just work exponentially against you.
Hey, Michael, you
That's
don't know this, but that is rule one in my 13 rules, some of the stats that you just quoted. So when we segue into that, and we better do that soon, I'm guessing, right, Zach? Because we're
Moving through it. I know this show's flying
we're
by.
moving through it. So
Yeah.
should we transition into that?
Yeah, let's do it.
yeah, we can do that.
All right. And hello, investors. It's Don Vandenbord here, and this evergreen show is going to highlight the 13 rules for investing success that I put together over the years. Joining us today is Alex Koutoudis and Michael Ramos, and I'm going to throw it to them for some comments on some of these rules. But let's just get right into it. The 13 rules for investing success, and we're going to start with rule number one. I reviewed 4 of these rules about a month ago, and we meant to get back to them. And I've been telling people, don't worry, we're going to get back to them. And but now we're going to do an entire show just going through the 13 of them. And as Michael just mentioned, rule one: never lose big. All investments are bad unless they go up. If you can just eliminate big losses from your investing process, you will save yourself a lot of headache. It's okay to be wrong. It's not okay to stay wrong. And here's the compounding that Michael was talking about. If you buy something and you're down 5%, you only need 5.26% to get back to even. Down 10%, 11.1%. 25%, 33.3%. You lose 50%, you need a double to get back. So this is compounding working in your favor if you cut them short, and working against you if you ignore your losses and let them get out of control. So that's rule one: never lose big. Rule number two: follow the trend. This is an old example of what the trend gauge used to look like before it got its design upgrade a couple of years ago. So follow the trend is knowing your time frame. We talk about this all the time. 3 time frames we track: short term, intermediate, and long term. Alex just brought up some good uh, questions about what should you do if you're a 401k investor. Ignore the short term, focus on the intermediate term and the long term, and we update this every night in our videos. Something too important: people, for some reason, uh, want to think that they get upset if they don't get the top or the bottom on a trade. If you're trying to sell something or buy something, there's only one person that gets that top and the bottom, and the odds are that it won't be you. So don't hyper focus on getting the exact top or the exact bottom with something when you're buying or selling. So that's rule number 2, is sticking with the trend. Rule number 3 is diversify, but don't de-worsify. And the analogy I like to make to this is, if you're following a well-balanced diet, and you go to the grocery store to get fruit and vegetables to be balanced, but they just happen to have very low inventory and the fruits and the veggies are rotten and picked over, are you going to buy them just because you want to have a balanced diet? No, you're going to ignore them and put something else there until they get good fruits and veggies back in stock. So there's no reason buying something that's in a downtrend just to say you're diversified. Proper diversification is owning the strongest uptrending investments over asset classes or sectors. You don't have to be in bonds if bonds are trending in the wrong direction. You don't have to be in emerging markets. You can get your diversification through sectors. This is something that William O'Neill teaches. That means if you're in the market, don't own 50% software stocks and then Apple and Amazon, because you're not diversified that way. You can diversify across sectors by finding the leading stocks among a variety of leading sectors. So no poor diversification just for the sake of correlation. Rule 4, watch list. You always have to be prepared no matter what's going on in the market. We keep a 21 over 21 list here that we update in every Friday night's videos. Alex and Michael keep their own versions of their watch lists and are constantly providing input to the Revere process, trying to get the best stocks for a place in there. And I would say probably 80% of our buys come from the 21 over 21 list. So if you focus it, look for good buy points, and the market is in your favor, you've got half of the battle conquered. So always keep your watch list fresh and up to date. Rule 5, buy on technicals and fundamentals, but we sell only on technicals. A lot of people make this mistake that, well, the stock just dropped 20% on earnings, but the earnings reports, the sales and the sales and the earnings were great, and they're gaining market share, blah blah blah. A lot of people said this about Roku. Let me bring up a chart of Roku, and Roku is the industry leader in smart TV operating system. No question about it. Roku topped in early 2021 at $485. Roku has continued to add market share, continued to become more popular. Everybody knows the term Roku now. Roku's at $81. So the fundamentals didn't change, but the technical picture changed, and this is why we sell. It's based on technicals, not fundamentals. We want to buy, factoring in both, because we're always looking for something, an N. This is the N in cancelim. Always want something new, a new product, a new service, new management, new business conditions. That leads us to identify the best stocks, and then we buy them on technicals, but the technicals take over, and that's what we lose to sell, or that's what we use to for our selling. Buy on technicals and fundamentals, and then sell strategy. This is what's so important. What is your sell strategy? This is the most important question to ask yourself or any investment advisor about any investment, especially when we're under the 200-day moving average. This is the sub rule. Never hold anything that is trending underneath its 200-day moving average. Now, when you break below it, this isn't going to say that we're never going to buy something below the 21, because if the short-term moving averages improve, such as you've seen what we talked about with the indexes, we're going to start to get involved again if we get back above the short and the intermediate term moving averages. You can still be below the 21, but this applies to selling. If you're holding on to something and it breaks the 200-day moving average, you got to get out of the way. And this statistic tells you everything that you need to know. Since 1960, 22 of the worst 25 days and 83 of the worst 100 in the S&P 500 occurred where? Under the 200-day moving average. The overall monthly return to the S&P 500 is positive 0.88%, but if you're under the 200-day moving average, the average return is negative 2.6%. Pretty clear. And here's the sell only based on technical action again. And the reason is leading stocks on average fall 72% from their peak. This is back to the numbers that Michael was talking about and that we showed on slide number 1, compounding. You lose 72%, you got to have a 257% gain to get back. The market just doesn't hand out 257% gains to everybody because you're invested in the market. So that was rule number 6. Alex, over the first rules, what's the main thing that jumps out to you?
I think buying a stock based on fundamentals and technical analysis, but recognizing on the sell side, price is the only thing that matters, and having a sell discipline. I would say that's the biggest one is the sell side discipline.
Absolutely. And there are my thesis is still intact. Saying that when your stock is down 20, 30, 40% means that the market does not believe your thesis, and there just might be a chance that you're wrong. Imagine that,
Yeah.
somebody being wrong. That's such a critical point to investing, is being able to put your ego in your back pocket and recognizing that you got to go with what the market thinks, not necessarily what you think. Michael, what's your takeaway from those first 6 rules?
Yeah, I agree. I think the most important thing you can do as an investor is to cut your losses, sell your losses short. There's nothing worse than holding on to a losing investment because you've done your research. The story's great. You believe in the product. Doesn't matter what you think. All that matters is what the market's telling you. And if you're wrong, you have to admit that you're wrong, which is something difficult to do. But you have to. Otherwise, you're gonna end up admitting you're wrong. If you don't sell early, you sell late, and that's the problem. Once it's too late, then it's just so much more difficult to come back from. So you've got to be quick at put your ego aside and get out when you're wrong.
There are a lot of highly intelligent people, doctors and lawyers, who make terrible investors because they're among the smartest people in the population, so they're used to being right. They're used to giving their wisdom to others, and for that reason, they can't admit that they're wrong in an investment that they make, and they're notorious for thinking it'll come back because they apply the same decisions that they make to their daily lives and compare it to the investing decisions, and ultimately, that's like treating somebody for hypertension with the wrong drugs, and their blood pressure keeps going higher, and you keep giving them the same thing. You got to admit at some point that you're making a mistake, and you got to try a new drug. And that it's no different with the market. You got to admit when you're wrong and get the heck out of the way.
Do you know
Zach,
the story? Sorry, do you know the story? It reminds me of Isaac Newton with the South Sea Company.
tell me.
That? So Isaac Newton, probably the smartest person who's ever lived, invested. He had some money in a company called the South Sea Company, and he bought a position. It was working against him. He doubled down on it because he had done his research, really believed in it, was incredibly the smartest guy ever, and ended up losing all of his money in this company because the stock eventually went to zero, and he rode it all the way down. So Isaac Newton can be wrong, then you can be wrong too.
I never knew that.
Yeah.
That's a good way of putting things.
Mm-hmm.
Zach, what's your takeaway from those first 6 rules?
Well, like I said, I know the least of all this stuff out of you guys. I'm definitely more in this podcast realm.
You're our man on the street, though.
I'm a man on
Zach.
the street. My takeaway is approach this stuff with caution. Like, it's dangerous no matter where you get in. You got to be smart. You got to know what you're doing, and it's not for the faint-hearted. So pay attention to the rules. Have rules. Follow them. You might just end up okay.
You might just end up okay.
You
I
might
like
just
that.
end up okay.
All right. Moving on. Rule 7, identifying low risk entry points. You do not want to chase stocks higher. That's called FOMO, fear of missing out. The 2 types of entries that we're going to talk about once you get your watch list curated is to find low risk entry points. And the first pattern is a high volume breakout. there are IBD classic patterns. Anybody that is familiar with William O'Neill, these are patterns that we use all the time: cup and handle, double bottom, flat base. And IBD research shows that 80% of successful breakouts never fall more than 3.4% below their proper pivot point. So I know they talk about 7 or 8%, but keep an eye on this 3.4% level. And if you hit that, maybe sell half. And then see what happens with the other half. So that's one way to get one foot out the door. The second pattern is low volume pullback. That is when you're in an uptrend and what you're holding pulls back on low volume into appropriate support areas, such as a moving average or a trend line or a horizontal line. Something that would present an obvious stop point if it broke below. So you get in at those two types of buys. This is for a bullish market breakout. Don't buy breakouts in a sideways trending or in a downtrending market. Low volume pullbacks can be bought in any type of market with the proper stop. So that's rule 7. Rule 8: stay out of the dumpster. When you're
I like that one.
buying stocks, knowing not what to do is one of the most important rules. Avoid stocks that are technically broken but are supposedly great values. It's like trying to catch a falling knife. Uh, that knife might end up in the top of your foot, or you might end up cutting your hand if you try to catch falling knives. So there's a reason why stocks are going lower. And remember, the falling stocks price action can remain irrational longer than you can remain solvent. So goes back to rule number 1 on the difficulty of rebounding from large losses. So avoid dumpster diving. Rule 9: relative strength. This is, if there was only one indicator that I could have on a chart, it would be relative strength. Now, relative strength is the comparison of every investment to the S&P 500. So naturally, the S&P 500 as the baseline has a solid blue line as its relative strength line. Let's look at one of the leading stocks in the market right now, Enphase. We want to compare how Enphase is acting to the market. And Enphase, you can see this relative strength line started higher all the way back at the beginning of May. This is saying that Enphase on a relative basis is outperforming the market. And notice, even while Enphase was going sideways here, the market, that's this black line up here, was correcting. So going sideways while the market is correcting is going to give you a positive slope to your relative strength line. And when the market rights itself and you have an inflection point, in this case, a great earnings report from Enphase up 317%, average volume, and the stock up 18% on the day, and then it followed through the next day. You can identify these types of stocks by seeing what is outperforming on a relative basis while the market is consolidating or going lower. So the relative strength line is, to me, the most important indicator that you can have on a chart. Okay, and this will keep you out of those dumpster dives, those value traps or bad theses like happened to Roku. Rule number 10: you got to understand the math of what's going on. Every outcome of a trade that you can have one of 5 outcomes. You can either have a big gain, a small gain, be near break even, a small loss, or a big loss. If you can just eliminate big losses from your repertoire, and for us, that is anything higher than a 0.2% of the overall impact to the portfolio. We are very tight on risk management here at Revere. That means when we take an entry point, if we're going to be wrong on it, we're going to sell it and the maximum loss that we're attempting to take is 0.2%. So that means if we have a 4% position and it goes down 5%, that's a 0.2% loss to the overall portfolio. If we have a 2% position, we can have a 10% loss on it, and it's still a 0.2% impact to the portfolio. You keep those small losses, and the big gains will take care of themselves. And one big trend pays for a bunch of paper cuts. And Albert Einstein may have said or not have said that the power of compounding is the eighth wonder of the world, but he certainly understood the math behind how compounding works. And it's a combination of the size of your gains, the size of your losses, and then your position sizing. And as I said, 0.2% is the max loss that we try to take in-house at Revere. Rule 11, building and managing a portfolio. This is a slide that I can probably add some statistics to, but it's important to track your trades because it's an instant feedback mechanism. Anytime I make a trade, I write down what the S&P 500 was at that time, and I'm comparing what the investment is doing versus what the S&P 500 is doing, and I'm trying to get a 2-to-1 return on what the S&P is doing. So if during the holding period the S&P was up 4%, I'm going to want my investment to be up 8%. And the reason is, if it's not, I can just easily buy SSO, which is the 2 times S&P 500, and save myself a lot of trouble. And that's why we're very picky with our entry points and our watch list. So building and managing a portfolio, always make sure that you're diversified, but make sure that everything is in an uptrend, what you're getting into, and track your statistics on your trades. Rule 12, this is a tough one too. This gets back to the ego. Mr. No Opinion. He looks a lot like Joe Friday. I close every video I do with just the facts or telling it like it is. Howard Cosell, that's another one. And this is something else that you have to put aside. When Michael first started with us, he was telling us how bearish he was with because of what the economic outlook was. And we had a long talk about just, paying attention to what the market's doing. We agree with you that the economic outlook is bad, but right now the markets were headed higher. And we were participating, and that's why, but we're participating and we've always got our stops in place. So no opinion. You've got to be a just the facts kind of person. Keep your mind open. When the wave comes, take it. You don't know how long it's going to do, but one way to stay objective is to cover up the ticker on chart and look at it. And if you didn't know what the chart was, and then you should be objective about it and just look at the pattern, not necessarily the name. And remember one more time, it's okay to be wrong. It's not okay to stay wrong. And rule 13 is not really a rule, but a summary, is commit to all the rules. Commit to rules 1 through 12. Tony Robbins said the path to success is to take massive, determined action. Rules 1 through 12 aren't an a la carte menu. That means you can't. If you went with rules 1 through 12 and you excluded the sell, you missed really half of the entire approach. So forget buy and hope, forget hang in there, forget ride it out, forget stay the course. This plan, these 12 rules that we've laid out, is a path to success in the market. Eliminate big losses, follow uptrending sectors and stocks, understand what the market is doing, and stick to your stops. Put your ego in your back pocket. You get to choose the pain of discipline or the pain of regret. And that's why I created this trend following strategy known as Grotection. You're going to grow your assets in an uptrend. In a consolidating market or a down market, we're going to focus more on protection than growth. And if you'd like to have more information on this, by all means, call us at Revere. You can email me, don@revereasset.com. You can email Dan at revereasset.com, or you can call 855-REAL-WEALTH, and we'd be glad to speak to you. And that's the end of our 13 rules. So let's wrap it up. Alex, final thoughts on these rules?
Thank you. I think it was great. I think people should definitely take notes. I've been working alongside Don for a year and a half, and he's not just putting these out there. He practices what he's teaching. So I think if you're going to get a genuine and honest person to manage your money, Don is the guy.
Oh, you make me blush.
Yeah, that's just the truth.
Michael,
Telling it like it is.
Yeah, telling it like it is.
telling it like it is. I love that. Just the facts, ma'am. Michael, final thoughts.
Yeah, I love the presentation. I mean, even though we work in the industry and we should know these rules, it's something that it's important to revisit and remind yourself of, because when emotion, this is a very can be a stressful job. It can be emotional, and you have to control yourself and just stick to a game plan and stick to a strategy and stick to the facts above all else. And like, for example, I have this little card that I look at every single day that I have on top of my desk, and it says, you probably won't be able to read it. Maybe you can read it here, but yeah, I remind myself every morning
That's
that
great.
For the
if I
audio
don't
folks.
Zach,
if I
was
don't
that?
stick to the
I don't think
rules.
that was on, Zach. Can you?
No,
Oh yeah, no,
yeah,
he's not presenting. Oh no, you did. Did you get it?
yeah, we saw it. Can you read it for
I
the
saw it.
audio
Okay,
listeners,
good.
Michael? Sorry.
Yeah,
For folks
I
who
can
can't
read
see
it.
video.
So it says, I look at this every morning. It says, "Good morning. My name is Michael Ramos, and I'm a loser. I have it in me to do serious financial damage to my account, because I don't want to get caught up in my beliefs and opinions. It's just, I know that this is serious. It's not a game, and you have to take this seriously, and just stick to the facts and stick to what the market's telling you."
Love that.
Love that.
Love that.
Zach, man
Yes.
on the street. Final thoughts.
Boy, there's a lot I don't know about this stuff. Final thoughts are no, these seem like great
But
rules.
you learn a little bit more every week, right?
I sure
Listening
do.
to us.
Yeah, no, and
Yeah.
these seem like really solid rules. Like they all seem to follow what we've been talking about for weeks. We're not playing anything outside of this playbook. Everything feels solid. Like you're right. You're planning for growth. You're staying within your margins, and you're always expecting that things can go south. And when they do, you got a plan in place for it. I think it's sharp. I like it. I like the 13 rules. I'm a fan.
Awesome. All right, so should I do the Danny Stewart wrap up?
100%. I was going to ask you to do that.
Yes, please. Yeah.
All right, folks, if you like what you heard, tell a friend, tell a neighbor. Send them to revereasset.com or call us at 855 Real Wealth. Join us back here next week on Your Money, barring any extraneous events.